I'd like to welcome Mr. Bond himself, Jim Grant of Grant's Interest Rate Observer. Jim, thank you for joining me. Let's get right into it. Chairman Powell, of course, getting ready to speak soon, outlined how he thinks everything's pretty much as planned. But one thing that's not as planned is how much money we are spending currently on these overnight liquidity operations, the repo operations. What do you think the total is going to be by year end?
Well, as of now, Rick, from the start of the operation in the middle of September to just about yesterday, we tallied up on a gross basis, just simply adding up all the dollars spent day by day, upwards of $3 trillion. This is a lot of money, even when you say it fast.
Wow, and I would guess that by year end, that's going to be multiples of that. Is this a de facto nationalization of the repo market that was once the venue of, all the different large institutions and primary dealers that seem to have just exited the space?
Well, the federal funds market, in which banks would transact on the basis of price signals to buy and sell bank reserves, that market, the Fed funds market, is kind of a ghost town. It exists in name only, and the Fed funds rate is for show only. What has superseded it is the repo rate, which is, of course, the collateralized rate. You charge that rate for lending against the collateral of Mr. Mnuchin's stock, bonds, and bills. So the repo market is completely dominated by the Federal Reserve. To that extent, yes, it is the property of the U.S. government. There's no more price discovery, and we are dealing with administered rates with huge amounts of money. I think it's kind of worrisome.
You used a great word, the article you sent used insouciance, which basically means this all happened in a very nonchalant way. There didn't seem to be any protests, no big stories, and granted, even I thought, well, it's just going to provide some liquidity. But now it is most likely going to be a permanent operation. I've been around a while like you have. What happened to using the discount window? Why has everything been, it seems as though we've moved from the lender of last resort, helping banks in the form of our central bank, to the market maker of last resort, the market lender of last resort. They're the last resort pretty much for everything.
Well, that is Karen Petru's view, and it's mine as well. She's the author of that piece you mentioned, Rick, in the FT last week. Again, what we have done to simplify this is to swap price discovery, which is, what made Chicago great, right? Open outcry,
exactly.
Supply and demand, and we've swapped that for the administration of prices, of interest rates, especially of money market interest rates. And what Chairman Powell will not say is, in the past 3 months, on an annualized basis, the Fed's earning assets, its bonds and bills, have grown at an annualized rate of upwards of 23% or so. And way back in September, before the eruption in the repo market, that was shrinking at a rate of about 9%. So very quietly, the Fed has done an about face. And whatever he says with respect to the funds rate, the Fed is very, very accommodative. And the rate of injection of high-powered money is very fast. It recalls to mind a little bit what happened exactly 20 years ago on the eve of Y2K. The Fed was at pains to make sure that no one worried about what happens if the lights went out at the year end. Well, the Fed is equally worried, if not more so, about what might happen if somebody forgets to bid in the repo market. So no more price discovery.
I'll tell you what, we're going to have to leave it there, Jim. But what you said really hits home. We went from open outcry to just crying and open that the markets aren't going to ever be like they were. And market participants in aggregate and all their decision making now boils down to a group of several men.